Hello, I'm Lee Stone, and this is your MaxiForex Week in Review. Today, we will be covering some of the top stories of the past week as they relate to the Forex markets. I will be joined by analyst Martin Smith, who will provide us with his insight on the events of the past week and perhaps give us some analysis for the week to come. For now, though, I'd like to move on to a new segment of our weekly review that we will refer to as the week's risers and fallers. In this segment, we will briefly cover the week's movement on all of the major currencies, as well as gold and crude oil. So, without further ado, this week's risers and fallers. The Euro-US dollar pair began the week at 129.34, closing at 129.11. The British pound-US dollar pair started the week at 152.98, finishing up at 154.25. The US dollar-Japanese yen started at 86.57 and rose to 87.45 by the end of the week. The US-Canadian dollar pair began the week at 105.77, falling to 1.0362 on Friday. Gold fell 0.3% to $1,189.32 an ounce, while oil jumped nearly 4% on the week, up from $76.54 to close at $78.98 per barrel. In headlines this week, there was marked a nearly 9% increase for the euro since last month's mark of a 4-year low at the height of the debt crisis in Europe. Oil reversed its losses from last week to jump over $77 a barrel, at some points even passing $78. The results of the Eurobank stress test were published on Friday, with very positive results from a European perspective. The results, however, have been somewhat overshadowed by strong skepticism from outside markets and analysts. The biggest news of the week came out of the United States, where reaction to Fed Chairman Ben Bernanke's semi-annual briefing caused risk appetite to fall and sent the dollar on a near 7-month low against the yen. For more on this, let us welcome analyst Martin Smith. Martin, how are you?
I'm fine, thank you, Lee.
Could you tell us about these statements from the Fed Chairman?
Yes, Bernanke's comments were a bit unnerving, to say the least, for most investors, because he stated that the economic outlook remains unusually uncertain. This choice of wording caused some panic among global investors, whose risk appetite had been increasing over the last week, and as a result caused the euro to fall a little and the yen to rise against most currencies. I think the interesting thing to note here is that the euro made gains the following day against both the dollar and the yen, surging to 1.2% gains on the day. Stocks, oil and copper also rallied amid reports that retail sales in the US were much better than expected. And in addition, there was also positive news out of the Eurozone, where data showed growth in the services and manufacturing industry. So the euro ultimately gained over the week, but I think the long-term prognosis remains uncertain, especially where the reaction to the stress test results. This fear versus optimism dynamic is really what's, I think, driving the market these days. When there is risk appetite, the euro is usually strengthening, especially when we hear data that indicates the region's debt crisis may be contained. And when risk aversion is strong, like at the height of the debt crisis, investors turn to safer currencies. More often these days, we're seeing that many investors are turning to the yen because the US dollar does not hold the same yield appeal that it once did.
So what about the news on these stress tests?
Well, the results in themselves are very positive. There were 91 banks were taken into account. Only 7 failed the tests, which has left many to assume that the tests were not strict enough. However, those 7 banks were also ones that were already failed or been on a watch list. It's a little unfortunate because it doesn't really tell us anything that we couldn't already conclude. It will be interesting to see when the markets open on Monday whether or not investors will punish the euro, or if they'll allow this news to push the market forward.
Okay. Considering the rising oil prices of the last week, could you perhaps provide us with some technical analysis on the US-Canadian dollar?
All right. Sure. Even though the trend was down, the initial trend indicator was pointing to a transition to a downtrend. Now, I believe the initial trend behaves much like an exponential moving average, where the more recent price action will be reflected in the reading. Notice that prices had begun trading in a range after making the low at 103.46. The 30-minute dollar CAD then began to trade within that floor, and the ceiling was at 103.93. Now, I think in a trending market, I feel there can be any one of 3 entries to consider. A trend follow from exhaustion or a correction. Secondly, a continuation. as prices move in the direction of the trend. And thirdly, a trend reversal. Now, since the initial trend offered an early warning to what could be a transition to, on the 30-minute time frame to a sideways market, which had already occurred, in fact, on the 50-minute chart, I also thought that a non-trending chart pattern alert, like the triangle pattern, would be helpful in identifying where the backbone and potential reversal level of 30-minute dollar CAD may be. Notice that on the 30-minute, indeed, it didn't indeed follow in the direction of the 15-minute and transitioned out of the downtrend, thus breaking the downtrend line resistance of both the channel down and triangle. And this, in turn, triggered a buy entry. Now, whether or not it would be considered a trend reversal or a momentum trade, in my opinion, has more to do with whether or not you felt the market was still in a downtrend. Anyway, the upshot of all this is that whatever happened, this would inevitably lead to a buy entry.
Thank you very much for that. Let's move on to our Ask the Broker segment. Nicholas Peters of Antwerp, Belgium writes, is there a difference when people refer to risk reversal in commodities trading versus currency trading?
Well, in commodities trading, this is a strategy for hedging that consists of selling a call and buying a put option. Now, the goal of this strategy is to protect against unfavorable downward price movements, but it ultimately also limits the profits that can be made from favorable upward price movements. If we take an example, let's say a company purchases a $25 August put option and sells a $29 August call option at even money, assuming that the put and call premiums are equal. Under this scenario, the producer is protected against any price moves in August below $25, but of course, any benefit of upward price movements reaches the maximum limit at $29. That's limitations. Now, in regard to foreign exchange trading, risk reversal is the difference between volatility between a similar call and put option. Now, this conveys market information, which is then used to make trading decisions.
Thank you very much, Martin. We hope you enjoyed your weekly review, and we hope you will join us next week. Until next time, be sure to visit us at MaxiForex.ru.